Our week 6 business 630 corporate finance lecture for week 6 is financial statement analysis and funding expansion, chapters 3 and 12. I have a spreadsheet in the in-class review section of week 6, which I'll be reviewing in my lecture today, which will highlight a lot of what I'm looking for in case number 3, which we'll review one more time tonight. My Friday update video this week will be considering also an update of some more lecture points on case number 3. And then I'll be available for office hours on Thursday of this week if any of you have any questions about our material. So let's get into it. Financial statement analysis. Many of you have taken accounting. Many of you have not looked at financial statements. You've already done some financial work already with your companies in our case number 1 video. But financial statement analysis is looking at key points of a company, of certain aspects of efficiency, profitability, management of assets. And those are the key points to develop and look at because it tells us about the trends or the history of the company and how they perform in their industry and with their current management. So it's a very important highlight to look at that. So one of the things I want to make sure we understand is these key techniques and key analytical information. Here's a page that I've taken out of your textbook, and naturally the textbook is optional here. That's why I've provided it for you, which gives a thorough review of selected key financial ratios and analytical information for a corporation. And this is also in our week 6 in-class review, a copy of it. It's also located in your case study, number 3. And this is the area that you'll be picking one equation from each of these areas. But what do these areas represent? Well, profitability. What's profitability? It's the share, the recording or the comparison of profits of your company to sales, to assets, to equity. What relationship is net income to these various things? And you take a look at the relationship in a percentage. The profitability ratio is really a percentage, profit margin on sales, net income divided by sales, operating profit margin, earnings before interest and taxes, or operating profits as a percentage of sales, return on assets, net income divided by total assets of a company, return on equity, net income divided by the common equity of the company, which is basically common stock and retained earnings. So this information tells us the relationship of profit in the company. What percentage is it? This is a key indicator for comparison to a lot of companies. What is our profit margin compared to another company or the industry average? This is one way of looking at financial analytical information for a company, is compare their profit margin for a period of time, a quarter or a year. In the case study number 3, you're doing it for a quarter in 2021, September, and 2020, and compare it to the prior year. How have we done profitability wise? Or compare it to the industry average, or compare it to a competitor. How are we doing in relationship to making money? That's the profitability section of financial analysis. Then you have the asset management selection or section of financial statement analysis. And this is usually in the form of a ratio or in a number of days, but usually in the form of a ratio. Total assets turnover, the relationship of sales to the total assets of the company. Fund fixed asset turnover, the relationship of sales to just the fixed assets or the plant assets of a company. Days sales outstanding, this is a very key indicator telling us the relationship of how quickly we collect our receivables. It's the relationship of your receivable balance at the end of the period divided by the daily sales of your company, which is annual sales divided by 365 days. How long does it take us to collect our money? And finally, inventory turnover. How fast do we turn over our inventory? Cost of goods sold divided by the inventory balance of the company. The higher the inventory turnover, the better you are because you're turning over your inventory, you're selling it more, and that produces more profits. Day sales outstanding tells us how quickly we collect our money, turning receivables into actual cash. You can say in this example here, it's about 36.5 days, a little high. So these indicators talk about how you manage your assets, how you manage assets in relationship to sales, receivables, and cost of goods sold and inventory. Asset management is this section. Then we have the liquidity section. The liquidity section basically tells us how liquid, how much cash or short-term assets do we have in our company. It's a ratio. It's the relationship. The current ratio is the relationship of current assets to current liabilities. Do you have enough short-term assets, the assets that have a value or a turnaround time of less than a year, to the liabilities you owe that you have to pay within the next year? That is a current ratio. It's called the liquidity ratio. And then the quick ratio, even quicker view of your liquidity by taking your current assets and subtracting inventories out of that, which sometimes takes a while to turn into cash, and dividing that by the current liabilities, the quick ratio. It tells you the relationship of liquidity in your balance sheet. Naturally, the higher the ratio, it means maybe you have too much cash. Maybe you should be getting rid of that cash and reinvesting. If you have a low liquidity, it means you don't have enough cash. So this is a very key short-term review of your asset management called liquidity. And then finally, your debt management, the relationship of debt to your business. Total debt to total assets. This is a number we like to use in our capital structure of determining cost of capital. What percentage is debt to the total assets of the company? Times interest earned, the relationship of earnings before interest and taxes, your operating profits, to the interest that you pay during that period of time. Are your profits significantly higher than your interest? If that is a small amount, like in the case here, 6.7, that means you're kind of highly leveraged in your business. You have perhaps too much debt. The price earnings relationship is the relationship of the stock price in the market to the earnings per share. And why that is important, it tells us about the equity position of your business. And the same with the market book ratio is a relationship of the stock price in the market to the book value on your balance sheet of a share of price of stock, which is basically the number of shares of stock outstanding divided by the equity of your business. Debt management. The key ratio in this one is debt to assets. The key one in liquidity is current assets to current liabilities. The key one in asset management is, I'd say it's even between day sales outstanding and inventory turnover. The key one in profitability naturally is profit margin on sales and also net income or return on assets. These are all key areas that we're studying in this week's financial analysis. Here's a financial statement of a company for years 2019 and 2020. It's the three main financial statements of a business that you all should be familiar with. Now, this is a pretty simple financial statement. The companies that you all have selected have quite involved financials, a little bit more detail. But at the same time, it's the same thing. It pretty much is the same thing. And here's the balance sheet of a company, the income statement of a company, the cash flow statement of a company, all showing key parts of this business. The balance sheet indicates how much assets they have, split between current assets and fixed or plan assets, and the short-term debt and long-term debt of the company, along with common stock and retained earnings. The income statement shows us the revenues less the operating expenses to determine our operating profit, EBIT. And then from that is subtracted interest to determine interest before taxes. We pay our federal and state taxes, and we determine our net income And from that, we drive and we pay a dividend. In this case, they pay a 22 cents a share dividend of $55,000. These are all figures to be used in this analysis of this week in week number 6. We're going to look at some key financial ratios to look at trends in the company. And we're going to do a AFN model analysis. And you do not have to be concerned with being able to calculate the AFN model, called the additional funds needed model, but understand what it means in regards to looking at the future needs of capital in your company. These are the three key. This is chapter 3. This is chapter 12. Here's a statement analysis of the company using some key ratios from that page from the chapter, and also the key areas that you're going to be working on that you have to select from in case number 3. The current ratio of the company. Notice the relationship of current assets, and I have the formulas right here if you want to look at them. The relationship of current assets to current liabilities of this company. And notice they have a rather high in 2020, 2.58 current ratio compared to the industry average of their industry, 1.25. What causes that? More specifically, the very high amount of receivables and inventories in this company that make up current assets. Companies have a lot of receivables. Matter of fact, their receivables went up $246,000 from 2019 to 2020. Their inventory balances went up $429,000. So they're holding a lot of assets, current assets. They got to turn that into cash rather quickly. That means collect the receivables, sell their inventories. And that's why many times you see in newspapers or on television commercials for companies wanting to have sales, to get rid of their inventories, to create cash flow, especially this time of year. Sell, 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 reduce those inventories. And that's why it's a very interesting way of looking at a company is how they collect their receivables and what's their inventory situation. I'm sure you work for some organizations where the inventory management is very important to your company. But notice in this company, their inventories and receivables are high, thus their high current ratio, dramatically higher than 2019 and dramatically higher than the industry average. The debt ratio, which takes a look at debt management of this company, the relationship of total debt to total assets. And notice in this company, it dramatically went down to 44% in 2020. The industry average is 65%. That's a pretty good thing. That makes up tells us that they cleaned up their balance sheet. But the key question in this company is, how did they clean up their balance sheet? They paid off $420,000 of a note payable. They paid off $500,000 of long-term bonds. But where did they get all that money, $920,000, to do that? Did they make a big profit? No. They only made $253,584 in profit. Where did they generate the cash to pay off almost $1 million of their debt? They issued stock. They issued an additional 150,000 shares of stock in 2020 and generated an increase in their common stock holdings on the balance sheet of $1.22 million. So they sold stock to pay off debt. If I was a stockholder of this company, I'd be a little concerned about that, because stock is the most expensive form of capital fundraising, as we have seen in our capital asset pricing model. The risk in the market, the required rate of return on our investors, those percentages are quite a bit higher than debt percentages and their cost. So this company sold stock in the marketplace and used that cash flow to pay off a majority of their debt, to make their debt position look a lot better. But at what cost? Usually companies issue stock to be invested in assets like plant, equipment, new products, new markets. This company decided to take their sales of stock and use it to pay off existing debt. Not much value or growth potential there for the company's shareholders. an important thing to look at. When we take a look at three profitability ratios, the relationship of profit margin on sales, the relationship of net income to assets, and the earnings per share of the company. And this is not on that page in the textbook, but I wanted to throw this in here because the earnings per share is what we usually look at in a lot of business publications and review of companies, is the relationship of net income to the shares of stock outstanding. And as you can see in this company, their relationship of net income to sales is only 3.6%. The relationship of net income to assets is 7.21%. Yes, much better than 2019, but at the same time, a lot less than the industry, than their competitors. Companies not making enough profit. Their market value or efficiency ratio of price earnings relationship is the company's stock price in relation to their earnings per share. What's the company's stock price at the end of the year? Well, if we go back to the financials, it was $12.17. That was their stock price at the end of 2020 in the market. Well, if you compare that in relationship to the earnings per share of $1.01, you get a ratio or relationship of basically 12 times the earnings. And you see this a lot in financial analysis of companies, especially in stock markets. How many times greater is the stock price over the earnings or the net earnings per share of the company? The higher the PE ratio, the more overvalued the company is in the market. You kind of want to look at a company with, as an investor, a low PE ratio. Now, as an owner of a business and the management, they would like to see a high PE ratio because they want to see that stock price go up in relationship to earnings. But it depends on what side of the street you are in regards to the company. So these are a couple of examples of those ratios, looking at it in relationship to a real financial statement for this company. These are looking at trends. How have these relationships changed? Many companies go back 3, 4, 5 years to look at this. In our case number 3, you're only going back 2 years, 2020 and 2021, looking for relationships, trends. Maybe looking at the industry average if you so desire. You don't have to, but what's their relationship to their industry? These are all important ways of looking at financial information from their financial statements. Another important relationship from their financial statements is to project out what are going to be our future cash needs in the future. Future capital needs. How do we want to grow? If you notice in this company's financial statements, their profit margin was roughly about 3.6%. And they paid out in dividends roughly 21.69% of their profits. That's their relationship of dividends. They paid out $55,000 in dividends of profits of $253,589. So they paid off roughly 22% of their profits back to the shareholders. And they made a profit, the relationship of net income to sales, of roughly 3.6%. Well, where do we want to grow in the business? Remember, most businesses, in order to compete, they have to grow. They have to develop new revenue streams, new revenue sources. To do that, you have to invest in capital, assets. Where are you going to get that money? Well, the AFN analysis here on this tab of the section talks about 2 key areas of financial capital fundraising. External sources of capital fundraising and internal sources. Internal sources means companies, money that can be generated from the operations of the business. Profits is an internal source of capital. If you make profits, you can generate those profits back into the company. Another item of internal sources, and you might think this is weird, is current liabilities, accounts payable, accruals. You go out and purchase something, you have, if you're using the accounts payable, you have 30 days usually to pay your vendor for that accounts payable. That gives you 30 days of free money, 30 days of taking that what you purchase from your vendor and turning it into cash flow by selling it, by turning it into a product that you're producing and selling it, producing return. Many times companies use that spread of 30 to 35 days to create short-term free money to reinvest back into the business. Now, it seems kind of short term, 30 days, but really, if you can turn around money quickly in your company, you can take advantage of that internal resource, internal source of current operating liabilities. Just think about in your own everyday. I have a credit card, okay? I need something. But I don't have any cash, but I can use that credit card and buy that thing today. I can bring it home and use it. I don't have to pay that until I get my next credit card statement in 30 days. So basically, I get this thing that I purchased with my credit card for free for 30 days. And then in 30 days, I pay for it. You don't want to pay any longer than that, then you'll have to pay interest. But I basically have that service, that product for free for 30 days. Multiply that by hundreds of millions of dollars with major corporations, that can give you an advantage in creating additional capital. So profits and liabilities, current liabilities like accounts payable, are internal sources, money you can generate within your company. When we get to talking about working capital management, that's a very important phase of business operations. External sources is when you have to go outside of the company to get capital. And the most obvious one is borrowing money, the bond market, going to banks, borrowing money outside of the company. Of course, there's a cost to that, the interest. Then also another source of external sources is naturally issuing stock. If you're a private company, going to Shark Tank, going to private investors, hedge funds, venture capitalists. But that comes at a price too. Why? When you go to the stock market or you go to the private investor market, they want either a piece of ownership in the company or a large piece of the profits and cash flow that you're generating in that company. That's a pretty high price. The key thing is external sources are expensive, whereas internal sources are cheap. But a lot of businesses don't have access to making a lot of money or don't want to incur a lot of short-term debt, because if they have cash flow problems, that means they can't pay back that debt in 30 days. So it's cheap, but sometimes in many businesses, it's tough to come by. For most companies, especially most corporations, they have to borrow those funds or issue stock, and both of those are costly. The capital asset pricing model tells that to us with stock, and our after-tax cost of debt tells that about the interest on debt. So by determining growth needs of a company and knowing where our sources of capital need to come from, that tells us and helps us a lot into the future. And here's an example. And again, as I said, you do not have to worry about knowing this calculation. Main thing from chapter 12 I want you to get a feel of is when I say what is an external source of capital, what is an internal generated source of capital, I need you to know those two things. That's going to be proving, we'll have those discussions in the electrics case and in other discussions like case number 4. What is an external source of capital? What is an internal source of capital? So let's take a look at this company that we're working at here this week. They have assets in 2020 of $3,516,952. Let's say they project a 15% increase in sales in 2021. All right. And let's say this company is operating at full capacity, meaning if they want to generate additional growth, they're going to have to purchase additional assets to generate that growth. They'll have to buy a new plant or new areas of investing in markets. So if this company is operating at full capacity, And they expect and think by their marketing and by their analysis of their industry that they can increase the business by 15% sales. That means that their asset base is going to increase by 15%. So 3,516,000 in 2020, if we project a 15% increase in sales, that's going to come to sales of asset base of 4,044,000. $527,000 of delta change in asset. Well, where are we going to get the money to make that profit? Well, current operating liabilities, the increase in accounts payable and accruals. In 2020, accounts payable and accruals were $739,800. If we increase sales in this model by 15%, that means we can increase our short-term borrowing by 15% to $850,000. That gives us a delta of 110. So we've now come up with $110,000 to fund part of that asset growth of 527. Another internal source of capital is profits. Well, remember in our statement analysis, we had a 3.6% profit margin in 2020. Well, let's assume we're going to keep the 3.6 profit margin in 2021 with an increase of sales of 15%. Well, 3.6% of an increased sales, remember our sales on our income statement was 7 million. We increase sales by 15%. We take 3.6% of that, we can determine our profit of being 291,622. That's 3.6% of our new sales growth figure projected in 21. Remember, we talked about dividend. We paid 21.69% of that dividend of profits in a dividend last year. If we want to maintain that relationship for our investors, so we take 21.69% of our profits, that's our dividend. What's left over is the difference. We made that in profits, we paid that out in dividend. We're projecting $228,372 of additional capital with a 15% increase in sales and a profit margin the same as the prior year and a dividend payout as same as the prior year. That gives us $228,372. So now we get to the definition of AFN, additional funds needed. If we need 527,543 in change of assets, where will that come from? Internal sources of accounts payable, 110. Internal sources of profits, 228. That leaves us with $188,201 left over called additional funds needed that we have to go out and borrow long-term or borrow in a bond issue or issue additional stock or find some private investors. That's additional capital we need to fundraise in order to get to our goal of supplying enough asset growth to fund a 15% increase in sales. Companies do this every year to determine what they have to do in the market to go out and attract new capital based on what they can generate internally and what's left over externally. And they can change their strategies. Hey, what happens if we decided not to pay a dividend and just use all our profits? Well, that leaves us with 124,951 AFN. What happens if we decide instead to increase our profit margin from 3.6 to 7%, maybe cut some expenses? Then we'll fully fund our growth rate because we're going to be making a lot more money. Well, sometimes that's easier said than done. Well, the long story short of this is for you to understand that we can use financial data to understand how we can project in the future. And there's many models out there. And this one here is called the additional funds needed model, which bases our growth rate on a projected increase in sales relative to assets, current liabilities, and profits. And whatever's left over is what we need to go hat in hand to the banks, to the bond members, to the bond market, and to the stock investors to raise additional capital if we want it that badly. Or we can change strategies within the company. Maybe not pay a dividend next year. Use that money to fund capital. Or try to cut expenses, cut divisions, cut departments, and make more profit that way. But at what sacrifice? Will our efficiency, will our quality be affected by cutting those expenses? Welcome to the world of financial management. So these are the definitions and the thinking behind this week's financial analysis figures, and using some of that information to get a snapshot of what do we need going into the future. And that leads us to our duties at hand this week of taking a real company that you've already selected in this course and applying these financial analysis techniques by looking up the information. You can do this by going to Yahoo Finance. You can use it by going to Hoover's. You can use it from many sources that even within the company, but you want to find the financial statements for September 2021 and September 2020 and pick one equation from those 4 areas and tell me something about it. What did they show you? What did they tell you about the trends in the business? Has the firm improved its performance? Is the firm managed more efficiently? As a potential investor with this information, would you consider buying or selling the stock? And do that in an analysis that compares, a comparison to industry averages would be pretty good. But what is your explanation of the financial performance of the company by doing this analysis? And the kicker is to put it into a PowerPoint presentation. And I gave you an example of that PowerPoint in our introduction to case 3 this past weekend, and that's will be my subject of our Friday video, is that PowerPoint and the many ways you can show this information in a very concise, conservative, to the point presentation of this work or this data that you're finding in case number 3. And that's the subject of my Friday video, the PowerPoint. Some of you might not have much experience with PowerPoint, but as a MBA student, you need experience as a PowerPoint going forward. And that's the subject of Friday's update video. So there we have it. We have all the grades posted for case number 2. The analysis has been done. And I'm now going to just briefly go through that case number 2 answers in case any of you have some questions on that. Case number 2 was for you to determine a capital budget analysis, which we're going to be doing in the electrics case in the next few weeks, to determine the cost of capital, and then a capital budget analysis of the base case of the data given to you in this case, and then to do a risk analysis, a scenario and sensitivity analysis. These solutions are now posted to Blackboard. The WACC analysis is a after taxes cost rate of 5.2%, which is 6.5% times 1 minus the tax rate of 20%, 5.2%. That 5.2% is weighted by the capital structure given in the case is 70%, 3.64. The capital asset pricing model is asking you to determine the cost expected return on equity. And this is where a lot of us lost some points. The market premium rate is given in the case, not the market rate of return. If the market rate of return was given, then you would subtract the risk-free rate to get your market premium. But I've already provided you the market premium. So you use 8.5% times the beta of the company, 1.3, and add that amount to the risk-free rate to get 12.70%. With debt being 70% of the company, that means 30% is the equity percentage of this capital structure, weighted 3.81%. Our total cost of capital then is 7.45%. We use that 7.445% to determine our discounted cash flow, which leads us to our variety of return analysis. We have a $700,000 investment depreciated over 7 years at $100,000 with a salvage value of $55,000, which will be considered a gain because you have fully depreciated the asset over time. Take the tax out of that, 20%, you net out with $44,000 in year 7 additional cash flow. Our sales are projected at 40,000 units a year at a $45 selling price and a $2 inflation rate every year, or $2% inflation rate. Our variable costs are projected at $35 a unit times the 40,000 units, and that inflation rate is 1.5% a year. The fixed cost is given to us at 75,000, and that is inflated by 1.5% a year. Thus, we get our earnings before taxes, sales minus these 3 expenses, taking 20% of that amount, give us our taxes, and there's our net accounting income for this case, $1.5 million. Our net accounting income is not the project cash flow income. We have to take into account working capital, which is given to us at a rate of 8% of the next year's sales. Thus, it deltas every year as our sales change with inflation. But then we add it all back in year 7 to net out 0, the total cash picture of working capital, but we're showing the proper cash flow in each individual year of this project. We add back in depreciation. We've already discussed the salvage value. We end up with about $2.4 million over 7 years of cash flow from this investment. We discount it back at the 7.45%. We get an NPV. We get an internal rate of return. We get a profitability index, the relationship of discounted cash flow to the investment. And we get a payback of 2.93 years. Pretty good. That's why for this project, I would think the resounding yes would be, should we approve this project? That's our base analysis. You'll be doing the same thing in the electrics case. Then we do a risk analysis where we look at 2 key areas of this base analysis and change them to see what would happen to our net present value or return. Our risk analysis of scenario shows the likely percentages of probability of achieving our base case unit output, a best case unit output, and a worst case unit output, putting those into our base case and weighing those by the probability. We get a weighted probable net present value, which is still pretty close to our base case analysis. So really, if the likelihood of a change, good or bad, in output in order to maintain our sales price of $45 and maintain all the expenses and other attributes of this case, it doesn't have much effect as far as scenario is concerned. Then what we do is we're given 3 variables in the case: selling price per unit, variable cost per unit, and fixed cost. And if we change those individually one at a time by these deviation percentages that are given, what is the net present value if we do change those individual variables one at a time? So you go back to the base case and you change selling price by a 15% reduction and so on. And we get an NPV, and I chart it here. All said and done, naturally, the steepness of the slope of the selling price per unit, because the delta range from top to bottom is $2.4 million. The delta range on variable cost, top to bottom, $1,857,000. And the top to bottom fixed cost changes is only $99,485. Those are the 3 numbers I was looking for. And then I graphed it here, and I was did not require this in your case, but if you did it, that's good, because that would be a nice handy tool to have in your electrics paper. That's the sensitivity analysis. It's using the base case to change specific variables one at a time to determine net present value and seeing how those ranges. Naturally, the most sensitive variable here is naturally selling price. That has the greatest delta from top to bottom, -15 to +15 deltas, than the other two. It gives us an idea that if we do have to change our selling price to maintain the 40,000 units output in the market, if we have to lower our selling price by 15% to sell 40,000 units, that's going to produce a loss. And if we have to increase our variable cost, if our variable cost increase, maybe a new wage contract, maybe new cost of materials, and they go up 15%, and if we maintain that 40,000 base case scenario, we're going to lose money there. All the rest of them give us some profits. But that sensitivity of those variables and wonder what circumstances that can occur can help us with management strategy about this project in the future. You're going to be doing the same thing in the electrics case. And these are the solutions for case number 2. Strongly urge you to keep these as a nice template for your future work. Okay, here's our Blackboard site, which I'm sure many of you are getting quite familiar with and here in our past the halfway point of our course. First of all, if you go to the case study section in case number 3, that's the case due this Sunday. Be talking a little bit more about that with the PowerPoint side of things on Friday. Here's the case number 2, where the solutions will be posted as soon as this video is over. In week number 6, here's that spreadsheet in this week 6 lecture review that I've given you tonight. You can use that as a guide to maybe doing case number 3. Here's the page out of the textbook that lists those key financial statement ratios. And if you go to the Business 630 assessment case file folder, you'll see now a checklist of key things that you need to find in chronological order in order to complete the electrics case. And this also will be the subject of my video on Friday, is to go over this checklist, make sure we're familiar with it. And I hope all of you have read the electrics case by now and have some idea about what it's involved with. I will talk about that specifically in my Friday video as well, where you can begin work on that. Remember, that is due the last week of our class. And I'll talk more about that on Friday, but keep an eye on this checklist. I give you a sample case paper for the electrics case, and here are all the information you need to complete this case. And again, we'll talk about that on Friday. And speaking of the electrics case, I have now set up a review session for Saturday, December 11th. Here's the Zoom link at 10 in the morning till noon. I'll be recording it as well, but a special session on Saturday, December 11th, in addition to my Thursday office hours, that there will be a Saturday session that weekend where we go over and review key components of the electrics case. Okay, well, that's our lecture video for this week, number 6. I'll see you all again on Friday to talk about the PowerPoint format of case number 3 and to talk more about the electrics case and also preview coming attractions in week number 7. We have some more articles to read in week 7. All right, everybody, have a great week. We'll talk to you. I might see some of you on Thursday night. Have a great week, and we'll see you again next time. Adios.